Hi, and welcome back, everyone. As always, my name is Michael LeBlanc, Senior Portfolio Manager with LLC Private Wealth at Canaccord Genuity Wealth Management. This week, we're going to do an episode of Mike on Money talking about interest rates, and obviously with the interest rates cuts that we've been experiencing, what that means for your portfolios, what that means for your investing, and how you can take advantage of those changes. So let's kind of jump right into what we're seeing out there and what we can expect coming up over the next 6 months and year. So obviously, if you've been following any of our regular videos, we do put out a monthly update for our portfolios. And we've been talking about interest rates for quite some time, going back to late 2021, early 2022, about the rise of interest rates and obviously historically rapid increase in interest rates over quite a long period of time. And then we've turned the corner. We saw inflation fall off. Interest rates cut start in Canada earlier than the United States, and obviously Canada doing a more aggressive cut recently with a half a point. Although the U.S. did just start their rate cuts with a half a point as well, and expectations, which we're going to talk about a little bit here over the next little while, is more rate cuts to come down in the United States, especially after we get through their election year. So what happens with rate cuts when we talk about the markets? Well, just like with interest rate hikes, some sectors or some companies will benefit from interest rate cuts. And to no one's surprise, though, those areas are sectors of high leverage, right? So technology companies, we've certainly seen the technology companies do quite well in 2024. Small cap stocks, and we've just started to see a turn on small cap stocks, especially in Canada and the US, but also globally. If you watch our monthly videos, we've got a nice exposure to UK small caps there for that reason, as they've seen 3 cuts for their rates over there. Consumer discretionary stocks tend to do quite well with rate cuts. Inventories are generally financed, so seeing that fall off. Real estate stocks tend to do well. Now, when we talk about real estate, especially over the last couple of years, there's been other forces at play there. I will say we do like the idea of real estate stocks. We haven't moved back into the REITs or the real estate investment trust quite yet, but they are close on our watch list because of those extra forces we saw coming out of the pandemic. We had a mass exodus from the cities as people went to remote work, and we also saw a mass exodus from office space and the brick and mortar retail space. Now that is coming back just through natural growth and this trend to come back into the office. You know, the remote work isn't working for all companies, and they're kind of driving, picking up new space. But the real story there that we're keeping a really close tabs on when we want to move into that is going to be that office space, mainly some brick and mortar retail, because they stopped construction. They stopped all the projects on new buildings as we saw this mass surplus. As natural demand starts to eat up that surplus, and the market decides, oh, we're running out of space. New projects like those take 5 years or more to get from start to finish. So you'll have this potential shortage of supply, or 5-year shortage of supply, depending on how fast that demand comes back. So we're tracking that really closely. A little bit off tangent, but that's one area to keep a really close eye on. Other areas that are going to do well with drop in rates is financial stocks. Canadian banks has been our favorite for 2023. We've got some great positions in there. Basically those loan loss provisions, or the risk of people defaulting on their loans, are going to start to decrease as those rates come down, because people can afford their debt more easily as the rates are lower. So the financial stocks, if you don't have some in the portfolio, most people, especially Canadians, tend to have exposure to the Canadian banks because they have traditionally done fairly well, although in 2022 you would have seen some negativity there. But 2023, we've just started to see some turnaround on those. and we quite like that as well. Commodity stocks also do well during rate cuts. Again, they have to finance projects, lowering that cost. Brings their overall operating expenses down, meaning more profit. So, commodities tend to do quite a bit better, and that actually ties in a little bit to the small cap stocks, especially if we're talking Canada, because the mining sector is, closely tied with small cap here in Canada. And as we see those prices come down, those two tailwinds for small cap and mining might play out quite well going into a bit of a commodity rally. Now, the other sector that you've heard me talk about many times is, of course, utilities. Utility companies finance their growth, and they also have other themes at play. I'm not going to dive too much into the utility, especially the electrical sector, because we're going to do a whole video. There's a whole can of worms we can open as to why we really like that sector and why we've seen some massive growth in there. But utility companies have been doing well in 2023 as we've seen the rates start to come down, and they have a lot more room to go, I believe. So, if you don't have a good exposure to utilities, and you might not, because the last couple of years or 2021 was a little lackluster as tech and growth stocks were the big theme. And 2022, with rising rates, of course, utilities got beaten up a little bit. So in 2023, if you haven't got a good exposure to your utility sectors, really take a look at it. If you have any questions on that, feel free to give us a call. If you have questions on any of these sectors and you're wondering how best to play them for your portfolio, because there's a lot of different ways to get exposures to these things, give us a call. We're happy to discuss, whether individual names make sense, or ETFs are great for sector exposure, depending on the size of your portfolio and the makeup of your portfolio. So those are all things that you want to look at. So let's take a little bit look at the forecast we see coming up. In Canada, we saw, as I mentioned in Q3 here, this 50 beeps or a 0.5% cut on the rates. Well, Q4, the expectation is actually for another 75 or 3/4 of a percentage rate cut in Canada. Q1 or the first quarter in 2025, we're expecting another 0.5%. The same for Q2, and then Q3 2025 0.25%. So from now till then, look at about another 2% in cuts for Canada going into Q3 or third quarter 2025 and fourth quarter 2025, kind of staying flat at about that 3% level. So that's the current consensus expectations for Canada from here till the end of 2025. That is obviously a moving target depending on where inflation numbers and economic growth numbers are coming in, but that's kind of liquidity that they're looking at driving to the market. At the low end, so the most aggressive rate cut forecast out there from the majors is that we'll hit 2.25% as our ending rate as opposed to 3. 2.5 is consensus. Sorry, 3 is at the high end, and actually RBC having the lowest at 2%. On the U.S. front, a little different. Obviously, they had that 0.5 point cut in Q3. The forecast is for another 0.5 point for Q4, and that's pretty much straight across the board. All the forecasts are in agreement on that one. In the first quarter 2025, the consensus is another 0.5 point. Now that does range from 1/4 to 3/4 on the different reports out there, but the consensus is around 0.5 point for the first quarter. Second quarter, they're only forecasting a 1/4% cut, and third quarter they're forecasting another quarter. So 1/4%. And then fourth quarter 2025, the consensus is 0, but some are still guessing on at least one more 1/4% cut. So that puts their ending rates down in the U.S. Consensus about 3.25. On the low end, 2.75. On the high end, 4. So we do have another year plus rate cuts kind of expected to come through. So those sectors tend to do well as we see that growth move through. The only sector I'll caution people out there about, as I mentioned, the first one is the tech sector. Obviously, and in fact, this goes for all the sectors I mentioned. Rate cuts and interest rates are a driver and influencer on all these sectors. There are other headwinds and tailwinds that affect them at all times, which is why I always put in these videos. These are for education purposes only. Do your own due diligence, or as always, reach out to us, because understanding those headwinds, especially the headwinds for those sectors, and how that's going to play out for those companies. And as I started that, the tech sector obviously has had a great rally here in 2024. That doesn't mean that's going to end. Obviously, rate cuts do help them, but they have a lot of other forces affecting that, and one big one is valuation. Obviously, there's been a lot of talk about the tech bubble, the AI bubble. How is that going to play out going into 2025 and into 2025? That's what you got to keep monitoring around that sector in particular. But it's true of all the other sectors, whether it be small cap, real estate. Real estate being a great example. As I mentioned, we're really tracking that sector really closely. We haven't jumped into it yet, but it's one that's definitely on our radar. But understanding those headwinds, because there are a lot of them, as rates come down, that's very positive, but there are other factors affecting it. So you just want to make sure when you move into some of these sectors, you have the right exposure for your portfolios. You have the right vehicle for your portfolios. That's really important. And also you consider the risk factors and the percentage exposures to each of those sectors as well. So that's it. I'm going to wind it up today on interest rates. Obviously, we'll be updating this as we move through 2024 and into 2025. It's going to be important to keep track of that. But if you haven't built any exposures to some of those sectors that tend to do quite well, do reach out to us. As always, we will gladly review your current portfolio, give you our commentary. My partner, Harold Leishman, and Julian Gojo are going to be putting out updated videos on our small cap stocks, which have been really doing exceptionally well for the last 18 months to 2 years. And part of that's due to to those rate cuts we've seen. So if you're interested in that sector in particular, they're going to have an update video coming up very shortly, but you can give them a call and get some answers around that. And if you have any questions about any of the other positions or sectors I've talked about, give me a call or reach out to us by email or comment on the video below. We're happy to answer any of your questions. So with that, I'll let you go, and we'll talk again soon when we do our video on power companies and where we see the future around those. Thanks very much. Talk to you again soon.